Good morning, everyone. So I'm going to talk about ESG investing and how we go about this in real estate. I'm going to speak for about 25 minutes and then hopefully leave some time at the end for questions. For those of you that don't know M&G Real Estate, we are the real estate investment arm of M&G Investments, now part of M&G PLC as of last week. We manage just under £35 billion worth of assets, and in general they are direct property holdings, equity holdings. M&G Investments do also run debt funds, but they're run out of the fixed income part of the business. We run a variety of internal capital, institutional funds, retail funds. So what do we do to embed ESG and responsible property investment into our investment decision making? M&G Real Estate has had a long-standing commitment to responsible investment, stretching back well over a decade now. We have a responsible investment strategy that we apply to all of our funds under management, which basically the aspiration of our approach is to try and create and enable world-class places that benefit our investors, society and the environment. And we have 4 key focus areas: environmental excellence, socioeconomic benefit, health, wellbeing and occupier experience, and smart, secure and connected places. And we believe by embedding responsible property investment, ESG thinking into our investment processes, that we are able to safeguard and future-proof performance, essentially manage risk and better identify opportunities, all of which can create value and manage risk. So on the right hand side, we've just got some of examples of the activities that we have been going on within our global portfolio. So we're invested, we still have a large proportion of our portfolio in the UK, but we also run large funds in Europe and also Asia. We have some assets in the US and Canada as well. So in the past year, we reached nearly 500,000 people with our health, wellbeing, inclusivity programs, and I'll talk a bit about that later on. We were the first in the real estate sector to be awarded the National Equality Standard. 27% of our assets under management now have some form of green building certification. We hold events all over the world for our residents and occupiers. And we achieved 10 green stars in the GRESB survey last year. For those of you that are familiar with GRESB, it's a annual benchmark of real estate funds and increasingly used by our investors to as part of the due diligence and ongoing monitoring of funds. So my team, I am head of sustainability globally. Have 2 other people in my team. And as I said, we work with all of the funds and fund managers within our portfolio. We, until recently, reported to Tony Brown, who's head of real estate, but I've just moved to reporting to our new head of investment strategy, which I think reflects our team, and our role is very much trying to embed responsible investment into all of our investment processes, not just day-to-day asset management, which I think traditionally is perhaps where sometimes my role has sat within real estate fund management. I mentioned GRESB earlier, so key driver for us and our investors, and we've participated in GRESB since the inception of the survey. And as you can see at the moment, that our funds on average are tracking above the global sector average. How many of you in the room are familiar with GRESB? So a fair few. We would say that's quite a key driver for us in terms of our strategy, but it's not the only driver. And we are very much trying to think about some of the long-term risks. So some of our strategy is to deliver performance in GRESB, but some of our strategy is to focus on issues that we believe are fundamentally important in terms of longer-term risk and opportunity creation. So in order to drive our strategy, we've got a series of 2025 targets. And again, these apply to all of our assets under management globally. None of the funds have opt-outs. So we are, by 2025, targeting green building certification for 50% of our assets under management globally. We are seeking to achieve a 25% reduction in energy intensity and associated carbon emissions against a 12-13 baseline. Whilst that's not a science-based target, it is based in science, so broadly it would put you on a science-based trajectory, but it's not a certified target. We want to achieve a 10% reduction in water, seek to divert 95% of waste from landfill. Under the health, wellbeing and occupier experience, we're trying to reach 10 million people with our health, wellbeing and inclusivity programs. We want to measure and improve the satisfaction, happiness and wellbeing of our occupiers. Obviously ensuring an exceptional standard of safety and security in the working environments we control. We own some of the largest shopping centres in the UK. We own Manchester Arndale. Obviously that was in the news a few weeks ago. So safety and security, huge priority for ourselves as investors. Socioeconomic benefit, we are increasingly focused on how we articulate the socioeconomic benefit of our activities to our investors, and how real estate ownership can create value in the communities we operate in. We're going through quite a big process at the moment to try and define some metrics and targets around that. We did a previous study a few years ago that looked at things like how many jobs are created both directly through our supply chain and also indirectly in the businesses that work in our buildings and also through our construction activities. We did some work on looking at how our assets create economic spend and money back to the economies. And our work at the moment is trying to look about how we can build on that and also create some focused areas of activity where we want to really demonstrate that us being involved is driving value creation, not just the ownership of buildings. Sort of related to that is we're trying to drive community programs at 100 places globally. And also under the smart, secure and connected area, we're looking to deliver enhanced digital and physical connectivity at our assets. And at the moment, kind of we probably have two key focus areas under that. One is around the use of some of the digital certifications that are coming out in the market at the moment, like Wired Score, which enables us to demonstrate to occupiers about how well connected the buildings is. And also we're doing quite a lot around electric vehicle charging, what infrastructure we need to put in, when do we put it in, what's the best solution for us to focus on. So that's the sort of activities that are sort of coming under that. And how do we go about kind of implementing that strategy? So essentially at a M&G real estate level, we've got those 2025 targets. For each of our funds, they have sort of complementary strategies and their own series of targets. So for example, and we try to reflect the market that those funds are operating in and whether we think we can go faster than the sort of house approach. So for example, for our European property fund, we have a target that we want to achieve 50% building certification by 2020 rather than the global one of 2025. Similarly, in Asia, our target is 60% building certification. Our residential fund has got a 75% target. So kind of reflecting that the market in those asset classes is going much faster, whereas say the UK, our certification targets are a bit lower because say in-use certification hasn't had as much penetration as the European market, so the market drivers are a bit less strong. So at a fund level, the accountability is obviously with the fund managers, and we meet with them regularly to update them of how they're progressing. Obviously, GRES being one metric within that as to how the funds are doing as well. And then we seek to integrate it in terms of our investment processes. So acquisitions is obviously a key point at which we can understand and manage the risk by not letting assets into the portfolio, or being aware of how we manage that during the ongoing asset management. We also have asset level responsible investment objectives, and we seek to drive that through sustainability asset plans, and also data monitoring and KPIs and SLAs for our property managers as well. And the ownership of that sits more with the investment and asset managers, and obviously our external property and facilities managers. So I'm going to talk about kind of two key themes within our approach today in a bit more depth: climate risk and the investment process, and then I'm going to talk about health and well-being. So I'm sure almost everyone in this room is aware of climate risk and what the data is telling us at the moment about our trajectory for climate change. At the moment, we're looking, based on current policies and pledges, at anywhere between about 2.8 to 3.5 degree warming. The science tells us that we need to be more in line with 1.5 if we are to mitigate against the worst effects of climate change. If we carry on as is, we're looking more like 5 degrees of warming. And obviously for the real estate sector, both of those sides of that coin come with an investment risk. If we're looking at less than 1.5, there's obviously a huge amount of capital that needs to be spent to make our buildings more resilient. We will get stranded asset risk. We're almost certainly going to get much more stringent regulation to drive that. But the BAU also comes with risk, because we're going to be looking at the physical impacts of that. So, you know, cities being uninhabitable, assets being damaged by more frequent storm and flood events, and also probably almost certainly down the line we're going to see more stringent regulation anyway kick in to try and rebalance things. So obviously one of the interesting trends that you can observe, particularly over the past year, is the sort of growing public awareness and concern about climate risk. And I definitely say what I've noticed really markedly over the past year is the sort of general uptick that we're getting in terms of questions about climate awareness. And I think one of the interesting observations is how much of that is coming kind of bottom up, that people are being made aware of it in their day-to-day lives rather than just thinking about it from their sort of work perspective. I've also been struck how many of my fund managers have observed that their children have asked them questions over the breakfast table, and that they're being challenged at home about what are they doing in their working lives. So it's very interesting. What that's driving is essentially we're seeing growing commitment, particularly in the UK and Europe, a commitment to 1.5. So obviously the government, UK government, passed net zero greenhouse gas targets by 2050 last year, with more stringent targets coming out in Scotland and Wales, and actually at the city level we're seeing more targets. I fully expect to see the EU follow that, and we're already seeing countries within the EU following that trajectory. Ourselves, along with a number of the other sort of largest property owners in the UK and Europe, committed last month to net zero by 2050, and committed ourselves to publishing pathways to achieving that by next year. And obviously on the occupier side, we're also seeing a number of the larger occupiers also committing to 2050. I think one of the biggest recently was kind of Amazon, but you're seeing DHL, Tesco's. So that there's kind of a growth from all areas in committing to net zero. Also from a financial risk and regulatory perspective, Mark Carney will be speaking later, so I won't quote him. He'll probably say it more eloquently than I. But TCFD, and particularly the aspect of TCFD, which is looking at scenario planning and how resilient our portfolios to 2 degrees, is obviously driving investor questions in this area. Over the summer, we were involved being prudential as the Bank of England have been doing a climate change stress test on both general and life assurers. And for real estate portfolios, part of what we needed to do was whether we thought that our assets were exposed to material risk under different scenarios. Scenario A being a disorderly sudden transition to 1.5 to 2 degrees. Scenario B, a orderly transition to below 2 degrees. And scenario C, current policy trends where we'd expect temperatures to increase above 4 degrees. And the really interesting and quite scary figures are what the Bank of England were attaching to scenario C in particular, which is the 4 degree scenario. So 60% reduction in asset values in Asia, 30% in North America, 15% in Europe. And so we've been going through the process of trying to, for this exercise, work out whether we believe our assets would be materially affected. And this is part of the bigger Bank of England stress test across all of the portfolios, so equities, fixed income. And this is also just a flavour of some of the investor queries that we received in the past year. And I think just the interesting thing to note is just the level of detail that investors are asking. So if I kind of contrast this to 5 years ago when it's, do you participate in GRES, what's your score? The sort of questions, what are your top affected assets? How are they going to be impacted? Can you put a value against this? And whilst I think everyone is kind of accepting that nobody has a sort of correct answer to this yet, it does just show the sort of level of depth to which investors are starting to think about these issues. So it's kind of, what does this mean for us as a real estate investor? Obviously there's two sides of the coin that we need to consider, the physical risk side and the transition risk side. And talking, sort of focusing on this in a little bit more depth, obviously from a real estate perspective, the interesting challenge that we've got is that at a global level, whilst there's a sort of curve of relationship between physical risk and transition risk, i.e. the harder we get legislation, so the higher the transition risk, in theory the lower the physical risk, and the higher the physical risk, the lower the transition risk for a period of time. But actually at a local level, we might not see that relationship. So if you take the UK, for example, which is committed to net zero 1.5, we will have a high transition risk. But if the rest of the world are not on that 1.5 trajectory, we also theoretically face a high physical risk as well. And there will also be locations and cities where even under a 1.5 degree scenario, we're facing high physical risk as well. So it's a pretty complicated set of things and factors to consider. So transition risk, obviously from a real estate investor perspective, I would say that the biggest issue for us is probably around the regulatory risk. And whilst there are opportunities, I think that you have to say that the risk for real estate is probably going to outweigh most of the opportunities, albeit there's likely to be funds that can take opportunities in it. Technological shifts, I think, will come into play, but if we're looking at kind of current technology scenarios, a lot of the things we're looking at are more expensive than the status quo. So net zero, what does that mean in a building context? First and foremost, it means high energy efficiency, and I'll come back to that point in a minute. Then it might mean some or all energy generated on site. For most buildings, total energy generation on site is unlikely to be the most viable option. And also it's unlikely actually to be the option that we would prefer from a regulatory point of view, because it's not necessarily the most efficient way of doing it. Then you kind of look at green zero energy procurement. And then finally, there's likely to be some degree of offsetting, particularly while we still use gas as the primary heating source. And decarbonisation of heat is going to be a really interesting sort of challenge, because at some point we've got to take a view on when heat is going to be decarbonised out of systems, and your viewpoint on that has quite a lot of impact on your asset management and investment strategy. Because at the moment you may not want to take gas out, because gas can be cheaper for the occupier. The technologies are more proven, and also in some markets, I've got an example later, gas is far more efficient than buying energy from the grid. So actually it's a better low carbon fuel at the moment, and the long term is the challenge. So the other thing we have to factor in when we're thinking about the transition risk and net zero is also about the legislative sort of background to this as well. So this is just an example of just from 3 countries where the legislation is sort of indicating it's going to go in terms of energy efficiency for buildings. So the ones in green are they're already written into law. The ones in grey are we have enough certainty that that's probably a likely trajectory. So I'd actually been presenting these slides internally, and I'd had a B EPC rating for the UK under 2035. The UK government has just come out with a consultation paper that's looking at a B rated EPC by 2030. So actually I was 5 years out in a not positive direction. So broadly what we're seeing is at the moment the legislation is predominantly based around EPC ratings, although in France it's based around a reduction in energy consumption, with the sort of slow movement to really quite high energy efficiency ratings. And that will be challenging, and that will require a lot of CapEx. And the challenge for ourselves as investors is, when do we make that investment? How far do we move along that line, knowing that this is likely to come? Do we sort of aim for B if we're doing refurbishments now, or do we aim for net zero? And also the fact, one of the interesting interplays, so B-rated EPC, it's the standard that's being used in the EU finance taxonomy for a green building. In the UK, a B-rated EPC does not guarantee you, say, a 50 kilowatt hour per metre squared level of performance, which is highly likely what we'll need in 2050 at net zero standard. So we're likely to see also some further regulatory shift to tighten up those standards to actually deliver operational reductions. And I haven't even talked about embodied carbon, which is, at the moment, our focus is around the operational side of things, because we don't do a huge amount of new development. We obviously do refurbishment, but even from an investment perspective, sort of embedding this operational risk thinking will probably be our focus for the next 3 to 4 years. And then embodied carbon is kind of the next challenge that we need to think about. So what have we actually been doing so far? So our 25% reduction target, we are hitting, as of last year, 23% reduction globally. And we've been delivering that through a hugely different range of programs. So easy wins like making sure that our property managers operate the buildings efficiently. We've done a massive refit of LED lighting across our portfolios globally. We have obviously been seeking energy improvements when we retrofit bigger bits of kit like boilers, air conditioning systems. We've also benefited from the fact that we've seen a sort of general improvement in the quality of some of our buildings, and we've got rid of some of our older stock. So our target does take into account our acquisition decision making as well. So related to that, we've also seen a 17% reduction in our absolute carbon emissions associated with that. It's fairly hard for us to track our energy intensity target against carbon at the moment, and we're looking to recalibrate that to net zero. And it's in part because of the fact that we're buying in different markets over time. So we have a target that we want to track global performance over time. But the challenge with carbon is when we buy in new markets like Germany and Australia, it obviously causes massive fluctuations in our carbon footprint. So we're tracking that in absolute terms at the moment. So we're looking to do some work around our targets. In the UK and increasingly in Europe, we purchased purely green electricity. Last year it was enough to power around 30,000 homes, and we're increasingly looking at on-site energy production, like PV in particular. So just to sort of give you an example also of how this sort of impacts our investment decision making, this is actually one of our assets in our Asia fund. And it's 2-storey towers, 26 stories. It has a LEED Gold certification and a huge amount of technology. It's got PV cells on the roof, it's got fuel cells, grey water recycling, also huge amounts of on-site amenities under the health and wellbeing occupier experience. And this is a really interesting example. So this has got pretty good environmental efficiency, but in terms of the net zero piece, it's using gas, much more carbon efficient in Korea at the moment. They're using grid electricity. But obviously at some point we will have to make a decision about how we get this building to net zero. So a great decision now in terms of environmental performance isn't necessarily going to be the best decision in the long term. And this is highly likely to be future-proof well into 2030s, 2040s, but at some point we will have to think about that gas issue. So physical risk. Obviously we're talking about chronic risk and acute risk, so more storm damage. This isn't the easiest thing to see, but it is worth delving into the IPCC report if you're interested in physical risk and actually having a more close-up look at this, which is basically, this is showing the increased likelihood of one-of-a-century flood events becoming once-in-a-year events. And the darker the dots, the sooner it happens. And the RCP 2.6, for those of you not familiar with climate change, that's around a 1.5 to 2 degree scenario. And RCP 8.5 is a 4+ degree scenario. And what you can see is actually there's some significant cities and investment markets around the world that will be affected significantly even under a 1.5 degree scenario. And again, even if we stopped all emissions today, we will be on a 1.5 degree scenario. So that is almost certainly what we'll see. It's just how far we see it. So physical risks for ourselves as real asset owners is a significant risk for us. Over the past couple of years, there's been some really interesting big data analysis coming out, particularly for the listed REITs, looking at where the underlying assets are and where the biggest risks are likely to be. And generally speaking, Japan, Asia, and the US tends to come out at being much higher risk than most of Europe, although not all of Europe. And so we have been doing a couple of things to think about physical risk. We took part in the UNEP FI TCFD pilot, who is working with Carbon Delta to look at physical risk modelling. We've also been looking at a couple of other providers to model our portfolio to understand it. It's interesting. It obviously shows that some of these models are in the very early days. I think that was reflected in Ben's presentation about the difference between, FTSE and MSCI. You do notice between the data houses, the models are quite different. So carbon delta, for example, in our portfolio in Asia, Japan comes out at quite low risk. And then you have other data sets like 427, which is this one, saying actually Japan is quite high risk. And part of that is to do with assumptions about flood defences in Japan. And so clearly those underlying assumptions that are built into the model have a huge impact in where you might view to be sort of safe locations. So I think following the theme earlier, the reliance on one model for climate risk modelling is unlikely to be the best way to go, and probably understanding 2 or 3 is probably going to be the most useful way of getting a handle on what the different models are saying, what they throw out. We're also of the view that it's highly likely our clients are going to throw our data through their own models, so we also need to know that if we tend to favour using carbon delta, if it gets thrown through 427, actually the list of assets at risk will come out quite different to what we work to internally. So that's kind of another challenge that we're sort of thinking about and trying to grapple with at the moment. 10 minutes, okay. So I'm very quickly going to talk about health and wellbeing in the built environment as well. So another massive issue that's sort of been rising up the agenda. I have a 4-year-old child, so I went on maternity leave about this time 4 years ago. And before that, if I talked about health and wellbeing to our investment teams, they would have thought that I was a bit mad. I came back off maternity leave and everyone was like, can we talk about health and wellbeing? And I was like, okay, right, what's happened? So it's been something that's come really, really quickly. And obviously I think it's to do with the sort of growing awareness that we spend about 90% of our lives indoors. Indoor environmental quality has a huge impact on our well-being. I think also the rise of kind of personal devices to monitor things like air quality, temperature, light is all going to have an impact. WeWork about a month ago had to sort of pull all the phone booths because they found formaldehyde in their US phone booth, so can have a real impact. And the more people can measure this, the more their expectations change on the quality of the environment that they want. So what are we doing? Whole series of things, training and awareness, information and services, and making amendments to the physical environment. This is just an example of one of our shopping centres in the UK. So we've done things like we hold Mental Health Awareness Week. We've installed changing places facilities. We've sort of had signage up, and we're doing audits at the moment with a UK-based organisation called Purple and Access Able to assess how accessible are our shopping centres to people, like above legal minimums, but actually how would anyone find that experience of using our centres, and we're planning to roll that out. Some of you may have come across also wellbeing certifications. This is probably the more glam end, particularly in the office market. This is one of our developments that's going on in Brisbane at the moment, ATN, which will be Well Gold certified, have lots of planting and biodiversity features. And I think the wellbeing certification, particularly in the office market, is kind of here to stay and is starting to set the standard for existing buildings. And just to finish, this is just an example of a net zero energy building in Singapore. And this is the bit that I think is quite exciting, and the opportunity, the sort of bringing together of environmentally efficient buildings that also create an amazing well-being and occupier experience. There's a huge opportunity for the built environment to create these great places, and that I think is quite exciting.